We're going to cover dollar value LIFO inventory method calculations. And the whole purpose of this is because what we're trying to do with LIFO is get rid of the inflation to see, did inventory actually go up in value, or did it just go up in value because of quantity, or did it go up in value because of inflation? And that's what dollar value LIFO is all about. Now, I have a little example right here, and this is the little scenario that we have on how to calculate the dollar value LIFO. The indexes will be given to you. This is basically your rate of inflation that you have for the company, and for our purposes this will be given, and this is just an index, and you take the current value divided by your base year values is what you have to do. Okay, so to calculate this, we start with the $10,000, which is our base year. Our index is 1. Now to get the inventory value, you take the 10,000 divided by the 1 by your index, and that will, oops, I don't want to do it there though. Yeah, base year index, and that's how you calculate it. Then to convert it back, you take the 10,000 times the 1, and that'll convert it back, and then that is equal, the total of that is equal to your ending value. So that's the first year, so of course that's going to be the same year because it's an index of 1.0. Now the second year, you notice we had a $12,100 value. The index, however, was 1.1. So you'll take the 12,100 divided by the 1.1, and that gives you a base year of 10,000. So for the conversion, we have to bring down the 10,000 times the 1, because that's our that equals then 10,000, which is our original. Now you have to find out, it went up by $1,000, so we need an extra 1,000. Now this will be at the new year, at the new base level of 1.1, which will give you 1,100. So over here you would have equal to the 10,000 plus the 1,100, or $11,100. So $11,100 would be what would be reported on the balance sheet as your ending inventory, not the 12,100. And in year 3 we have 13,125. Index is 1.25. So you notice it looked like it went up again in value, right? It went from 12,100 to 13,125. But our base year is what they call converted into real terms, or real dollars. Remember that from economics? And it actually is only 10,500. So for this, you need to bring down the 10,000 times 1.0, which is equal to the 10,000. Now you notice we don't need the 11,000 this year. It went down. So we only need 500 times the 1.1, which is equal to the 550, or our inventory over here is equal to 10,550, which is these two added together. Okay, so if you don't use a year, it's gone forever, and if you need to take away, like here, the 1.1 will stay at 500 unless we don't need it again. So the third year, we have 16,800, and it's 1.4 is our index. So we take these I got too many zeros in there. Okay, let's get rid of the 0. Okay, so over here, let's take the 16,800 divided by the 1.4, and notice it's 12,000. So it went up again. So you compare it to the year before. So we bring down the 10,000 times the 1.0, which equals our 10,000. We have the 500 times the 1.1, which equals the 550. Now we need an additional how much? Well, we have 10,500 accounted for, so we need an additional 1,500 units, and that will be at the new level of 1.4, which is equal to 2,100. Okay, remember we don't use the 1.25, and we can't restore this one, so this one's gone. So the new level that we need is 1.4. So then you add those up, and that gives you 12,650. And then the last year we have 12,360. The index is back to 1.2. Now this is all indexes always compared to the base year. So we have, oh, I got the wrong number there, don't I? 12,036. I hit a wrong key evidently. Okay, the base year is always it's always compared to the base year. So divided by for the indexes. Oops. Equal 12,360 divided by 1.2 is 10,300. There we go. So you notice what happens. We need to bring down, you always bring down the base year because it's LIFO times 1.0, which equals to the 10,000. And now the second layer, we only need 300 of it times the 1.1, which is going to equal to 330. So that gives us a 10,330 ending inventory. So that's how you calculate dollar value LIFO. Okay, use the indexes. Indexes will be given to you. First time you take the value, the current value of the ending inventory divided by the index to get a base year inventory value. This takes out the inflation rate. Then you compare to see if it went up or down or not, and then you convert it back to the current year. You always use the base year times the current year that you're in, okay? Or the level, bring down all the levels that you need first. And then if you need extra, like here, we bring down to 1.4. And here on this one here, we only needed 500 of it, so that's all you bring down. Okay, that is dollar value LIFO. Hope that helps.